Valens Research, Uniform Financial Analytics.
The last company that we'll look at is Yelp. Yelp, when we look at it, it is telling how much more expensive and how much poor return the market wants you to, the as-reported metrics make you want to think this company is doing than it actually is. This company doesn't have a 1% ROA that just flipped positive in the last year and a half. It has a 15% ROA that has been declining, but it is a robust positive ROA. On top of that, this name isn't trading at a 16 times, 17 times multiple. It's only trading at 11 times multiple. This company's PE isn't a little bit lower than market averages. It's almost half of what market average PE is. This company is cheap and far more profitable than as reported metrics show. And you can see that too, right? And just if I say, hey, let's look and say, if I think that Yelp probably is slowing down their growth, the market right now is pricing Yelp to see ROAs get cut in half, right? From basically 12 to 14% levels to 6 to 7% levels over the next 5 years. In reality, part of the reason why the market thinks that is because the market already thinks that Yelp isn't a profitable company. But when I understand what Yelp actually is doing and the fact that actually ROAs are forecast to stay stable for Yelp the next 2 years, in line with what they were last year, I can actually say, hey, what do I think Yelp is worth if I think that all of these strategies that they're doing means they can preserve their economic moats, right? And this is the question is for Yelp, the question becomes, for Yelp, what do I think the company can do? Do I think that because of their strategies to basically grow into referrals and everything else, that they're actually building their economic moat and going to be able to maintain it, in which case I think they can maintain their ROAs? Well, in this company is a double, right? It's not worth $35, it's worth $78. But if I think that they're going to continue to have their competitive pressures hurt because the fact that Google is putting the exact same thing on that Yelp does in terms of Google reviews and trying to wipe the floor with Yelp, and I think that that's actually going to happen because I understand the network effect that Google has and that Yelp really is only highlighted on Bing, which fewer and fewer and fewer people use to do search every single day. In which case, if I think that, then the market has it right. But right, you can have that conversation now because you understand the real returns to the business and you understand what the market's really pricing in. You can't possibly do that and have an educated opinion if you're using distorted as reported metrics. And that really comes down to the core of it, what we do here at Balance. We're here to help you understand what the real returns are of business so you don't get stuck making poor investment decisions on poor financial data.
Valens Research, the world's leading source for uniform financial analytics.